Here's what the wealthy know. Estate taxes aren't just for billionaires. They use a strategy that most families have never heard of until now. I'm Brennan Vitali, CFP and founder of Vitality Wealth Planning, and I help families design estate plans that outlive them and outsmart state taxes. Most families think estate taxes only apply to the ultra wealthy, but in Washington, anything over $2.2 million, taxable. Today, I'm going to show you how estate taxes work and how the wealthy legally avoid a 50% plus hit using a specific type of trust. Washington has its own estate tax, not income tax, estate tax. If your estate is worth over $2.193 million, you could owe 10 to 20% before even touching federal taxes. And this estate tax exemption is not portable without proper estate planning. Your home, your 401k, stock portfolio, they all add up quickly. So say your estate is $3.5 million. Your family could lose $100,000+ to the state alone. No warning, no check in the mail, just gone. And here's what many people miss. This tax applies to your gross estate. That includes everything: real estate, retirement accounts, life insurance proceeds, even business equity. If you've built a business or inherited property, it's easy to cross that threshold. While federally, there's a $13.99 million exemption for now. In 2026, that's scheduled to drop in half. So likely around $6 to $7 million, unless something changes on the tax side. But everything above that, taxed at 40%. So if your estate is worth $10 million, your heirs could owe $1 million+ to the IRS. Add Washington tax and the total bite could be nearly half of your legacy. But the wealthy, they're playing offense. They're reviewing their estate plan every few years, updating trusts, coordinating with attorneys, CPAs, and advisors. And it's not a one-time fix. This is an ongoing strategy. And timing matters. Planning before the exemption drops in 2026 can mean millions in tax savings. Gifting strategies, trust funding, entity structuring can all take advantage of today's higher limits, but only if you act early. This is the playbook high net worth families use. Irrevocable trusts let you move assets, real estate, life insurance, stocks, out of your taxable estate. And once in the trust, those assets grow outside the estate tax system. And with proper planning, you can have a say in how and when your family receives them. Because you're not giving up your legacy. You're giving up the taxable liability. And let me be clear, this isn't about hiding money or moving to offshore accounts. These are legal strategies used by responsible families who want to leave behind clarity, not chaos. And there are different types of trusts for different goals, so let's break down a couple. First, we have credit shelter trusts, or AB trusts. These are used by married couples to preserve both spouses' estate tax exemptions, but without regular review, they can unintentionally disinherit their surviving spouse or create inflexible restrictions, so you have to review them. Next is irrevocable life insurance trusts, or ILITs. These remove life insurance death benefits from the estate, saving hundreds of thousands in taxes, but if not structured carefully, you can lose the flexibility or even trigger gift tax issues. Next is spousal lifetime access trusts, or SLATs. One spouse gives assets to the trust for the benefit of the other. Great for maintaining access while removing assets from the estate, but if both spouses use SLATs for each other, you risk the IRS calling it a reciprocal trust and unraveling the entire plan. And then next, if you're charitably inclined, we have charitable remainder trusts, or CRTs. These let you generate income during your life and donate what's left to charity while removing your assets from your estate. But they're irrevocable, so once it's in, it's in. Your family needs to be aligned with that charitable vision. And lastly, disclaimer trust. So these provide flexibility by allowing the surviving spouse to disclaim or refuse the deceased spouse's estate, thereby funding a bypass trust, but only if needed. But they require timely decisions, usually within 9 months, and precise language in your will or trust to work effectively. And lastly, I just want to mention annual gifting strategies. So this isn't a trust, but it's just as powerful. And in 2025, you can give up to $19,000 per person per year without incurring gift tax. And this is used widely. This reduces your taxable estate over time while supporting your family or funding education. But if done wrong, it can disrupt your eligibility for certain benefits or trigger unnecessary paperwork. And that's the point. Each tool solves a specific problem, but no trust is magic. Every trust has its trade-offs, and the biggest mistake I see is picking a strategy without thinking through the consequences. Because estate planning isn't just about the documents. It's about the outcomes. It's about what happens. So for example, a Seattle family owns a $4 million investment property and they transfer it into an irrevocable trust. So they remove the control of this property. And so when they pass, it's worth $7 million. And because it was inside of the trust, they legally avoided hundreds of thousands of dollars in taxes. No loopholes, no gray areas, just smart, proactive planning. Now imagine that same property wasn't in a trust. Their heirs could have faced a huge tax bill, payable within 9 months of their passing. So would they need to sell that property? Do they have cash to pay it? Or do they need to take out a loan? Because it's not just numbers, this is real impact on real families. And that's the power of clarity and action. Because when your plan is proactive, your family doesn't have to just inherit money, they inherit peace of mind. And Washington estate tax kicks in early, and federal estate tax kicks in big. But you don't have to play defense. You can play smart. You built something meaningful, so don't let half of it vanish because no one told you what the wealthy already do. So I put together a free guide on estate planning basics. Click the link below to download it because protecting your legacy is simpler than you think when you have the right plan.